So we're going to run through just a couple of myths here.
One of the things that I'd heard him say via video and that Mike taught me is he used to say that most people's understanding of life insurance is from someone else's misunderstanding.
When we talk about reassessing your prior, a lot of it comes down to where did you hear these ideas from? Where did this come from? So for instance, breakfast is the most important meal of the day was an advertising campaign by the pork industry. You have to deal with the fact that persons who have little knowledge of a subject almost invariably form definite and positive judgments upon that subject.
It works the same way. You get slow results in day by day and huge results over time.
I view this as we're sitting down at a chessboard and our opponents are the government, the financial institutions, corporations, and the overall marketing arm of the three. They're not on your side.
All of those institutions, they want your money as often as possible, as much as they can get. They want to hold it as long as possible.
But this idea that life insurance is a bad investment is fundamentally flawed from the start because
welcome back to Remnant Finance for episode number 2. We're going to talk about the most misunderstood asset. How you doing today? What's going on, Hans?
Good. Still just dealing with relearning parenting of a newborn. It's amazing how all she does is sleep and eat, and it takes our entire day. And the harder part has been the toddler and trying to wrangle her while allowing our newborn Talia to sleep. But it's exhausting, as you know, and grateful that we have in-laws in town who were able to come over and help for a couple weeks. Once my wife's parents leave in about 10 days, my parents are coming in the next day to help out. So I don't know how people do this without additional hands, especially at the early stage. And I certainly don't know how single moms do it because we're spinning our wheels and barely treading water with a bunch of extra hands. So still tired, powering through. How about you?
Yeah, that's awesome, man. We're just in busy season wait until they get a little older. All it does is shift. My oldest is playing volleyball. She's got 3 practices a week plus games on Saturday. My son I think he has baseball 4 days a week or so. And my daughter has soccer 4 days a week. So my wife and I completely split the difference, just try to keep up with everything that they're involved in, man. This is our crazy month, or April, May into June. So crazy season for us, but it's all good and it's great. Dude, it's wild what you said. Like I don't know how my wife did it, man. She's incredible. But when our first baby was born, I was in my final phase of pilot training when I was at Altus, Oklahoma, and called me with water broke. And zing home, I missed the birth by 4 hours. And then 10 days later, I left and went back to Oklahoma for a few months. She was born in November. I finished up there a couple months later. So my wife did it alone. She spent a lot of time at her parents' house, but it's crazy. It's hard to believe she was able to hang in there with such a lack of sleep by herself, but the trooper.
Yeah, that's wild. I cannot imagine. For those who don't know, Brian's son is a stud catcher, getting training from some pretty big names. So keep tabs and let's look for a Moody behind the plate in the majors in a couple years, maybe 10 years.
See, he's putting in the work, but we'll see how it goes. And it's all about that compounding interest and compounding work, right? It works the same way. You get slow results in day by day and huge results over time. That's how he's done it.
Yeah.
Hey, let's roll into what we wanted to talk about today, the most misunderstood asset. And obviously for us, what we're talking about here as it pertains to the infinite bank concept is whole life insurance. And I remember watching a video. I unfortunately never got the opportunity to meet Nelson. My first mentor is a guy named Mike Everett, just a fantastic guy. And we're still super close friends, but he really helped me out starting into this business. And so he was a direct mentor, knew Nelson for, I don't know, close to the last 15 years of Nelson's life. But so I get a lot of secondhand input there and just watching all the videos and everything I could on Nelson Nash. One of the things that I'd heard him say via video and that Mike taught me is he used to say that most people's understanding of life insurance from someone else's misunderstanding. And I believe that to be absolutely true because I canceled a whole life insurance policy. I think it was with MetLife. A friend of mine sold it to me in probably around 2004. And it wasn't a participating whole life insurance, but it was still probably a decent policy. And I canceled it because I started doing the Dave Ramsey program. And Dave Ramsey told me that whole life insurance was terrible. And his misconception of this product led me to believe that was the truth about the product. And I canceled a perfectly good policy that would have been just ripping and roaring today. And someday in the future, we're going to have probably an entire Dave Ramsey, Sue Zorman episode. And it's going to be awesome. So it's absolutely true. And that was one of my past things, was my understanding of life insurance was based on his misunderstanding.
Yeah, same. I had in flight school, I got set up with First Command. Great people over there, but a nightmare to unwind some of the products that they get you into. I had a whole life policy through them, which I canceled about 5 years into it. Knowing what I know now, I know that it wasn't a well-structured policy for IVC, but it was a good life insurance product. And if I had held on to it, I would have been able to access all the living benefits that we talk about on the policies that we set up. And so in hindsight, I wouldn't have canceled that. I would have canceled the other mutual funds that I had been put into, and I would have kept that whole life policy going. But decisions that you make, including right now, are the sum of the best information you have up to that time. And there was a time where I thought that following the Ramsey, et cetera model, that I would be much better off closing this policy, taking my tiny amount of cash value due to the way that it was structured, and putting it into the market. So anyways, what we want to talk about today, when we start with this idea of rethinking our thinking, which is a common phrase from Nelson that you're going to hear over and over in this podcast and any other IBC content you listen to, rethink your thinking. So I want to talk about reassessing your priors, starting from scratch on a topic, challenging your own beliefs, and having the, I'll say, intellectual integrity to go back to square one, a clean slate, and say, where did I get this idea? And be open to learning new things, because I had to do that. I mentioned last episode when Brian sent me this book, I tossed it aside because I knew whole life was a bad product. Eventually, by trying to disprove this concept, I came around to it, but it really took humbling myself and the financial mindset that I had for over a decade. And I was a big advocate of the conventional model. I was a big advocate of I was very into personal finance, reading, learning on my own. And I would have told you that I had a pretty astute understanding of the financial planning model. So it was a bitter pill to swallow to realize that I had wasted a decade of time that I could have been growing with guarantees instead of subjecting myself to this risk, et cetera, all the things we talk about.
What's the best time to plant a tree?
20 years ago.
And the second best time?
Today. So I've got those trees planted. They're a year or two old now. I wish they were 10 years old. One thing that every single client says to us is, I wish I had known about this sooner. I wish I had started a long time ago. We've had 50-year-old clients say that. We've had 23-year-old clients is the youngest, I believe, that I've heard say, I wish I would have started this sooner. And so the best time to start is today. But when we talk about reassessing your prior, a lot of it comes down to, where did you hear these ideas from? Where did this come from? And so when you look at the products that you have right now, your 401k, mutual funds, whatever you have, your financial junk drawer, whatever that is, consists of these disparate products, how much time did you spend learning and diving into them before pulling the trigger on them? And for most of us, myself included, it was very little time. It was at someone else's recommendation, likely someone who had possibly conflicting interests with us. We took their advice, we jumped head first, and we didn't really reconsider it. And that's why we talk about the financial junk drawer, because people made decisions a decade ago and never really went back, looked at, is this on track? Is this doing what was promised? They all just drift apart. They just drift in their own directions, and there's no cohesion there.
And that's funny because you mentioned that, because when I think about, I still have money locked away in the thrift savings plan until I finally depart the reserves here with the Air Force. I had that money locked in there, and I have no idea right now the fees are. I have no idea what any underlying fees are. All I know is that at some point I trusted somebody else that told me to put the money in there because of how it's going to grow. And I did zero background on it. Now I know that it's not the product that I want to be in anymore. But even at this point, whenever what I do for a living is in this stuff, I still haven't taken the time to figure out what those fees are, because that money is already locked away and I don't add to it. But it's interesting. I never even considered finding out what that money was invested in, how it was going to be moved, what the fees were going to be, and all the background information. So just as guilty as everybody else.
Yeah, I really am interested in this topic. And so I'm going to flow here. So I want to go back to a book called Crystallizing Public Opinion. The author is Edward Bernays. He was Sigmund Freud's nephew, I believe. But he basically was the father of truly it's manipulation. It's mass manipulation, but when it's couched in academic terms, it's psychological marketing. And so a lot of the concepts that we take for granted, that we just repeat without ever thinking about, have been strategically placed into our vocabulary through a very intentional marketing effort. And it started back with Edward Bernays and I believe the Edward Bernays Institute. And so in grad school, we studied a couple of my classes. We talked about some of the concepts from his book and how they came about. And these might seem crazy, but these aren't like debatable theories. This is bragged about in these books. So some things that we always hear that we don't really know where they came from. And my point with all of this is, where did you hear this? And would you be willing to reconsider it? Because a lot of these things that I'm going to bring up here are provable marketing campaigns that we take as common knowledge. So for instance, breakfast is the most important meal of the day was an advertising campaign by the pork industry. The bacon producer specifically hired Edward Bernays and his company or his institute to promote that message. Now, a lot of people in the world don't eat breakfast. Breakfast is breaking your fast. People generally would eat later in the day. Now, across the world, people do different things, but like the idea of having this big breakfast is unique to America. Just like we've all been over to Europe and they do a little continental breakfast. They might eat a little bit, but most people just don't have this idea of a huge breakfast, whereas we call it the most important meal of the day. And you can trace the marketing campaign back to Edward Bernays. 4 out of 5 dentists agree on fluoride. That was a marketing campaign because the byproduct of aluminum production was too toxic and expensive to get rid of by the safest means. And so essentially they took a trace element of fluoride and said that this will whiten your teeth, it'll help with your gums. And they sent out flyers to dentists, and the ones that didn't return that implied implicit agreement. And so the 1 out of 10 dentists or whatever the number is that actually sent the flyer back and said, what is this? Why are we putting a byproduct of aluminum production into our mouths? Why is this heavy metal going into our toothpaste? That was the 1 out of 10 or the 1 out of 5 that disagreed. But the marketing campaign was 4 out of 5 or 9 out of 10 dentists agree. And that's a campaign that's bragged about.
And I think again, somebody can check me on this because I read it so long ago, but I want to say it was in Freakonomics where they talked about some of that stuff, like the 4 out of 5, and some of the manipulation of those statistics was that all they had to do was have 4 yeses and a no, and they would regroup the data set however they wanted to. So if I quizzed 100 and 89 of them said no, and I had 11 out of those 100 or whatever, all I had to do was grab 4 of those and 1 dissenter. And if I grouped those 5 together, or maybe it was like 5 in a certain order, if these 4 came in with 1 no in there, it was 4 out of those 5, and they ignored the other 95 and just threw that data out. So the manipulation even goes so much further than what you're saying. It's fascinating. And I think that breakfast is the most important meal of the day. Didn't that have something to do with Kellogg's too? And then that tied into sugar and fats and all that kind of stuff. Was that around the same time?
So I'm recalling from Edward Bernays' book called Propaganda, and I believe it was a bacon company that specifically chartered that marketing campaign, but I'm not sure who else was in there. Skim milk is another example. That was basically a waste product. When you milk a cow and cream rises to the top and everything that good that you use, what's left over after that is skim milk. It's essentially a waste product, and so you feed it to your chickens or you just get rid of it. But the dairy industry paid for a marketing campaign that skim milk was healthy, and so that they could sell it. And so for decades, people thought skim milk was healthy, and in reality, it's mostly just the waste product of actual good, healthy raw milk fat. Food pyramid, all these ideas, these now debunked ideas, all of them can be traced back to marketing campaigns. So in another one of his books called Crystallizing Public Opinion, Edward Bernays talks about the role of what we now call a PR person, the public relations, your marketing team, etc., is basically controlling the relationship between public opinion and the institutional messaging, and how they each have an impact on each other. But the fact that you have a concentrated source of money and influence that can be propagated out through the means of communication means that the institutions have a large sway on public opinion. And so a quote that stood out to me is that a professional PR person must deal with the fact that persons who have little knowledge of a subject almost invariably form definite and positive judgments upon that subject. And we learn about things. We like to think that we are well read. We like to think we have a strong understanding, but a lot of that is controlled by what we read. I'm going to highlight that again. You have to deal with the fact that persons who have little knowledge of a subject almost invariably form definite and positive judgments upon that subject. And so how many of us, myself included, had a definite and positive judgment about whole life insurance? And when I say positive, I don't mean viewed in a positive light, a strong, forceful opinion on it. And we know from the father of mass marketing that those opinions can be implanted into us. And read all about Edward Bernays. It's fascinating how in that industry, they view public opinion. All that to say is I hope that if you do come to this podcast with those definite and positive judgments on whole life insurance, that you will consider continuing to listen and learn and start with that blank slate that a lot of us had to come to after we reassessed our prior assumptions. Come to the table with an open mind and think, maybe I've been misled, and think, where did I get these opinions from? How much time did you spend, like we talked about, how much time did you spend learning about the other products you have? Now we have conversations with clients. We'll be talking for 4 or 5 hours. We'll do a couple of Zoom calls, we'll do a phone call, we're answering emails, and they're diving into the details of this product. What exactly are these contractual rights? How exactly does this aspect work? We have a whole list of FAQs, and we're going to cover a lot of those in this podcast. But at the end of it, we like to ask, hey, just out of curiosity, we've done several calls with you. You're forming a really good understanding of what you're getting into, which is good. We want that because because this is a paradigm shifting financial change. This is a paradigm shifting financial strategy. Everything changes with this because you view capital differently. And I'm glad that you're spending hours and hours learning, reading. You can talk through this in detail. That's what you should be doing. But just out of curiosity, did you do the same thing with your 401k? And Brian talked about most of us didn't do any research at all. So consider this the blank slate starting point. And if you have prior assumptions about whole life, let's move forward together and we'll talk through those and see if we can't come to a better understanding of what this product actually is. And if you can't at this moment list all of these living benefits that we're going to cover in detail, then I would suggest that you are exactly the kind of person that can do what I did as far as going back to the basics of zero. Start with that clean slate, wipe away all of your previous misunderstandings, and let's move forward together and talk through it and learn and understand the power of this product, because it truly is the most powerful financial instrument that you, hopefully, if you're insurable, can access as a client or as a consumer.
Yeah. And that primarily Remnant Finance, we are an education company. So we're happy to walk through that with you. Hopefully pull back those weeds and carve out some new ruts in your brain and get you out of the old ruts. And totally lost my train of thought.
There's a book by William Poundstone called Priceless, and it elaborates on what Edward Bernays did. And it talks about a lot of these principles. Tversky and Kahneman were two economists, Nobel Prize winning economists, who studied a lot of these effects and how there's so much psychological impact behind decisions we make. And then again, how to manipulate those. So one example that stood out to me from reading that book, Priceless, was the effect of anchoring. So the idea that you walk into a purse store, if that still exists, but right in front of you is an extremely overpriced purse. It might be $6,000, right? And that's the first thing. And you're not supposed to buy that purse. You're supposed to recoil at the price so that when you go around the rest of the store, the other ones that you see for $1,200, even though those might be wildly marked up, they seem relative to your first number to be a lot more reasonable in comparison. And so you set that bar so high that what you actually want to sell, the $1,200 purse, seems like a bargain. And another example of that was fascinating was a study they did where they would take a selection of people and they would ask them, the two questions was, do you think the average annual temperature in Phoenix, Arizona is above or below blank number? And the second question is, what do you think the average annual temperature in Phoenix, Arizona is? And so they did it to three different groups. So to one group, they said, and I'm going to make up the numbers here. I don't remember the exact numbers, but to the first group, they said, do you think the average annual temperature in Phoenix, Arizona is above or below 91 degrees? And people would answer above or below, but what they really wanted was that second line. And what do you think the average annual temperature is? They got that number and they took the average of those answers. Then they took another one, and the second one was a lower temperature. And they said, do you think the average annual temperature is above or below, we'll say 82 degrees? Above, people answer above or below. And the second question, which is the data they wanted, was, what do you think the average annual temperature is? And they gave that answer and they averaged those. And the interesting thing was, when they said 92 in there, the answers that were given were really close to 92. When they said the lower number, they were much closer to that number. And so they're able to show that by setting that first number, you get an idea in your head. And even if you think you're going to be influenced by that initial idea, that's the anchoring concept. But the third one was the most fascinating. They took a raffle pinwheel, or not pinwheel, a raffle wheel kind of thing where it like clicks through Wheel of Fortune with different numbers. And they said, we're going to spin this wheel. And whatever number it lands on, we're going to plug that into this question. So people knew, they were told right off the bat, this is going to be a random number filled in. And what do you think happened? They spin the wheel, the number hits. Is it above or below this number? What do you think the number is? And that number that people knew was a totally random number that they watched the wheel spin, it still drove their answer to within a standard deviation of that number, that totally random number. It drove people's assessment when they had to come up and put a number there, even though they knew full well it was totally random. So that's just an example of the power of anchoring and getting this idea in your mind to where you approach a subject with incomplete information or intentional misrepresentation of information, and then you make decisions based on that. So again, we want to say that the majority of the disparaging marketing around whole life insurance has as much validity as spinning that wheel to find the average annual temperature. And we want to reassess that, knowing that a lot of that information is garbage.
And even before we get to whole life insurance, I think that a lot of these preconceived notions that we have really starts with just a very simple topic that you and I have talked about a lot, and we've talked about it a lot with members of our practice, and that is the basic differentiation between saving and investing. And those two things have just been completely clouded and muddied up in they're almost used synonymously. in the common vernacular within our country. And it's so if I ask somebody like, how much money do you save? I would say the most common, or what percentage of your income do you save? Or however I want to phrase the question, I'd say the most common answer that comes back is, oh, I put percent, or I max out, or I put this amount into my 401k or into a Roth IRA or into an SEP or an IRA or whatever those vehicles are. And so right off the bat, we have completely changed through that marketing the idea of what savings is and what investing is. And I think that's been done by institutional, I'm going to call it malpractice for lack of a better word, but institutional marketing and manipulation, maybe even lies and deception, because we're surrounded by that for sure. If you guys haven't figured that out since 2020. And so everything we talk about when it comes to infinite banking starts from a savings and an investing standpoint. And I think the marketing has probably completely manipulated that idea around what those are in the general public.
Yeah, absolutely. So we're going to run through just a couple of myths here. And throughout the course of this podcast, we're going to continuously hit on these as well as other myths and misconceptions. So this isn't a comprehensive list, but these are some of the most prevalent ones that we hear. And these are the ones that most often come up when we first start talking to a client. And they want to ask these because this is what they've absorbed through this manipulative financial media. I know that a lot of people try to assume good intentions, and I think there is a place for that, but we don't ever want to be a podcast that tries to sugarcoat or says that this isn't the place to talk about that. This isn't a political podcast. This isn't a cultural podcast. We're just talking about finance. We think that it all ties together. We think that culture and finance, the economy, our personal lives, our morality, our faith, everything ties together. And so we want to be able to hit on that just as an aside. So we do, on individuals, we can assume good intention, but I don't feel any need to ascribe good intention to a corporation who is beholden to stockholders. I think we can say, or we can make the assumption, make the claim that there's very likely intentional bad advice, misaligned marketing, etc.
Yeah. And actually, I want to expand on that because remnant finance, like we, Hans, you and I often talk about what we call as the 5 F's. And that was borrowed from Rabbi Daniel Lapin, actually. And then I've, over the last few years, incorporated this into my life, and that there's 5 main areas of your life. And that's faith, family, fitness, finance, and friendship. And in some ways, a lot of those things, like friendship, ties into just relationships in general. Family's obvious, faith is obvious, finance obvious, and fitness is a whole bunch of things. It's going to be our own mental well-being, our own physical fitness, our own growth mindset, abundance versus scarcity, all that kind of ties into that category. And so that's a conversation we like to have about all the areas of our life. And the thing is that what we do, and when we give financial advice and what we do with life insurance, with infinite banking concept, ties into every one of those, because the easiest way to have a bigger impact and live more intentionally in all those areas of your life is to have your financial house in order. If your financial house is a wreck, all those other things fall with it, because you lose focus on the things that are important in your life. So just by getting a good, stable foundation in our financial lives, we can be better in tune with our faith. We can be better in tune with our family. We can actually be present for them. We can be fit because we're not worried. We're not stressed about money. We're not working harder. We're not working an extra job, all those sorts of things.
We came up with some of the most common myths that we hear and that we've previously had. And so we came up with this list. And then yesterday I was just going through trying to see if there's any other ones that were common out there. So I just Googled life insurance myths with the intent. What I was looking for was other common misconceptions about life insurance from the perspective that we have, which is that the myths about them are the disparaging and terms you always hear, and those are what we are trying to counter. However, if you search life insurance myths, you're not going to find a single article along those lines. Every single article you're going to find, if I pulled up on my screen here and showed you the Google search, you have Forbes, you have Motley Fool, you have NerdWallet, you've got Investopedia, you have all of the financial institution media, and they all have articles about whole life myths debunked, etc. And they're all from the perspective of trying to disparage whole life. So again, you can't go and just casually stumble your way into finding these living benefits and the value of whole life, because there is an institutional barrier that is very aggressively trying to prevent you from finding this information. And that's why we want to join the small number of IBC podcasts that are out there to put this information out there to counter that, because you're not going to organically come across the things we're talking about here by searching Google, because the institutions have that locked down.
That is true. And I think that in order to find what these living benefits are, which we're going to cover in the next episode, you would literally have to know somehow to search what are the living benefits of whole life insurance. But if all you've ever heard was about how bad a place it is to put your money, that what does Dave Ramsey say, that they're going to take your cash value whenever you die, and all these things that we're going to talk about here in a moment, how would you know to search for the living benefits? Nobody ever brings up the fact that they even exist. So it's almost impossible to find on your own. You're right.
Yeah. And I view this as we're sitting down at a chessboard and our opponents are the government, the financial institutions, corporations, and the overall marketing arm of the three, which essentially in our system of government work together in tangent against us. So we're sitting down at the chess table, and you are too. When you're making your financial decisions, you are sitting down at that chess table against those three. They're not on your side. They're going to tell you through the marketing arm that they are, but they're not because you have conflicting interests. So our goal is to sit down next to you on your side of the table and explain to you these benefits and bust some of these myths and be an ally on your side of the table, because there's no one out there that cares more about your finance and your family's future and the well-being of your kids once you pass on from this earth than you. Certainly not the people on the other side of the table. And they are there. And you are playing against them whether you know it or not. You might feel like you're on the same side of the table with them playing against nobody, but there are conflicting interests here, and they're going to win unless you are very well prepared. And we want to sit down at the table with you on your side and help you become prepared.
All of those institutions, they want your money as often as possible, as much as they can get. They want to hold it as long as possible. And if I have to explain to you that the government is not out for your best interest, maybe you shouldn't continue listening to this podcast, because I think you're a lost soul. But yeah, let's jump into what some of these myths are. So I started to say earlier, life insurance is one of multiple things: a bad place to put your money, a bad investment, or even a bad product. What do you have to say about that?
That's a very simple one. And the foundational underpinnings of that assumption get back to the savings versus investing misunderstanding or misapplication of terms. Life insurance is not an investment. It's a savings vehicle, which has a ton of benefits from which you can invest. But when people compare what you could be doing in the market, AKA exposing your principal to risk in hopes of future gain, that's an investment. That's not comparable to what we're talking about here. The right comparison, the more accurate comparison would be, where is your savings currently allotted to? Someone sitting on that savings, where is that money right now? So it's an apples to orange comparison every time when people say life insurance is a bad investment, because they are bad compared to what, and that what is an actual investment product when we're not talking about investment here.
Because I don't think we've laid out what savings really is. And I'd say the massive two components of any savings vehicle: we want it to be safe and we want it to be liquid. I put my money into a Wells Fargo savings account that for the last 15 years got 0% interest. I wasn't looking for a rate of return. I wasn't looking for anything other than the fact that if I needed it, I knew my money was available in that savings account. And if I needed it, I knew I could go get it. It was the only reason I would have put money in that place. And that's the only two they offer. It's safe, supposedly, and it's liquid. I can access the money. So when we're comparing these, we need to start with that premise. Is it safe and is it liquid? And then from there, we can look at all the reasons why whole and life insurance takes care of those two characteristics, adds a lot more characteristics, and doesn't have anything to do with an investment, to bring it back to your apples versus oranges.
Yeah, and just a very simple logic chart here. If someone comes to you and says, hey, I have a great real estate investment deal, it's going to be guaranteed return. You need to put up this amount of money. Here's the terms. Here's the contract. Just a fantastic deal. And you have two places to pull that money from. You have savings, you have investments. If you just think about the fact that you want to use that money for a purpose, it's going to likely come from your savings account, because the other money that's being invested is supposed to be doing what you want to be doing with this new investment anyways. So maybe you would wipe out your current investment knowing that this is a better investment, but you should understand that money that is currently being invested is different from the capital that you want to save to potentially use for future investments. We'll talk about how we use these savings in the whole life policy for investments without actually diminishing the principal. But again, it all comes back to this misunderstanding of savings versus investing. So we're talking about a savings account. You can compare this to your Navy Federal Chase checking account, Chase savings account, whatever, high yield savings account. That is the actual comparison to make here. And when we talk about savings over and over, we're not saying not to invest. The dollars that you currently are invested had to come from somewhere, right? To put money into that real estate syndicate, to purchase that stock on Robinhood, the money had to be sitting somewhere. And so we're talking about that reservoir where those dollars are currently sitting. And what we want to do is not just wipe out your investments to put it in savings. There's a balance in everything, and there's a balance here. But we want to take where those dollars are currently residing and optimize them into a more efficient storage location. By using whole life, that storage location happens to grow guaranteed and allows you to access it without reducing the principal and getting all the other 20 plus benefits that we're going to talk about in detail in future episodes. But we're talking about the most optimal place for this money to be sitting before you do something with it. not what could you be doing with that money. Again, that's the apples to orange comparison. We want to take advantage of the multiplication of money effect, which we'll have an entire episode on. But this idea that life insurance is a bad investment is fundamentally flawed from the start, because we are not talking about an investment here. We're talking about the most efficient warehouse for our capital. Nelson's second book, Warehouse of Wealth. Where do these dollars flow into initially before they're deployed?
And that's true, because investing, one of the things you're doing is you're intentionally separating yourself from control of that money with the expectation of a return. And when it comes to whole life insurance, I'm not intentionally separating myself from the money. I'm not giving up control with that expectation. Now, I can leverage it and invest it in that way, but I'm still keeping an environment of guarantees and security within. So I'm mitigating the potential losses of the investment, because when I invest, there's a possibility that's going to go all the way to zero. There's a possibility that's going to make me wealthy. There's a possibility that it's going to drain everything.
Yeah, and if we do a good job at conveying these ideas, you will understand what I mean over the course of future episodes when I say Brian and I are both investing, but we've built a wall between the risk and our principal. We've built a castle wall to where anything we want to go do outside the wall that involves risk, we can do so strategically, understanding that risk, but we do it from a place of strength where our principal is not at risk. So we want that separation between risk and our principal. And any other savings vehicles, you're not doing the two things at the same time. You're not saving it while investing it like you can with IBC. You can move it from a savings vehicle to an investment, but that's just a one-way transaction. And now you're just depleting those savings. And so it again, that comes back to blurring the lines between saving and investment, because those two pots of money, your savings and your investment, those two general broad accounts are just treated as one, and money moves back and forth between them. But when they move from one to the other, they leave the other one entirely to the tune of that amount. And what we're doing is separating those to where both can exist simultaneously, but the risk is all independent and separate from your principal.
What's another myth that you commonly hear?
We could call this the Dave Ramsey myth, because that's the place I've heard it the most. And when people talk about this, it almost seems to exclusively come from his content. But that is that the insurance company keeps the cash value and only gives you the death benefit.
And I think that it's absolutely ridiculous, because it's a complete misunderstanding what cash value is versus what the death benefit is. And I think Bob Murphy, he explained this pretty well, or he counters this pretty well. He talks about the example of a mortgage. If I compare the cash value of a policy to the equity in your home, and nobody says, hey, I've made payments over the course of all these years, and whenever they sell the home, like, I want to get the value of the home and I want to get all the money that I've applied of what it was worth through the years. Nobody ever gets upset about that. Like, well, I've made all these payments for a decade. Why are they keeping that? The bank's keeping that. They should be giving me the sale price of the house, which would be like the death benefit, and the equity that I gained in the house over time. Like, that just doesn't make sense. And it really comes down to a misunderstanding of what the cash value is, and a common misunderstanding of the fact that there isn't some piggy bank full of cash at the insurance company that represents your little slice of how they do business. So you don't have a pool of funds like you have in a savings account. What you have is a contractual right to a certain value, and that value is known as the net present value of your death benefit. So the death benefit in a whole life policy is this future cash flow. We don't know. That's part of the risk that the company has taken. They have an actuarial idea of when you're going to die, or when most people your age and health status are going to die. And so that's how they've based the premium of your policy. Now, they know that somewhere in the future, there's going to be this cash flow when you die, as long as you've paid your premiums throughout and held up your end of the bargain. That cash flow is going to come at you at a certain level. So every time you make a payment, you have less at risk. It's called the
net amount at risk.
Thank you. The net amount at risk. And so as time goes on and more money you pay, their net amount at risk decreases. If you think of like your line going up a mountain to that future cash flow. Right now, since you've paid premiums, you have a certain value. That's the net present value of that future payout, that future cash value. And that is all your cash value is. They're saying, hey, in 20 years, 30 years, 40 years, someday, no longer than age 121 in the United States of America, we're obligated to pay you this death benefit. If you want to cash that in right now, what it's worth. And so that's if you and I make an agreement and I say, hey, give me a little bit of money and I'm going to invest it elsewhere. And then in 5 years, I'm going to pay you $5,000 Brian, and you come up to me in 6 months and you're like, hey, I need that money. I'd be like, we haven't reached the agreement of the 5 years. So when I account for inflation, for future cash flows, the premiums you would have given me if you kept giving me money to invest up until that point, where are we on that mountain? We've only accumulated a little bit of it. That's your cash value. So I can't give you the 5,000 we contractually agreed to for 5 years down the road. We're only 6 months in. I can give you, I'm making up a number, 500. That's what it would be worth if you kept holding up your end of the bargain. So your cash value is just what that contract is worth today. Is no actual cash in the policy. Is a contractual equity like in a mortgage.
Some numbers on the home equity example, like to put some meat on that bone in case like you're more numbers oriented than perhaps concept oriented. If you have a $500,000 house and you know that the equity in your house is $150,000, and you have a $350,000 mortgage, to keep numbers very simple, you list that house and you sell it for $500,000. You get the $500,000. Now, this is before you pay off your mortgage, but you get the $500,000. That was the sale price of the house, to keep it very simple. You don't then say, hey, wait a second, I got my 500 because that's what the home was worth, but I also had home equity of $150,000. Last week, when I ran my balance sheet and I found out that I had $150,000 in equity in this home, why are you keeping that? You only gave me the sale price. That analogy there is the one that Brian was making, to where your cash value would be your home equity. So if we use the same numbers, if you have a cash value of $150,000 and a death benefit of $500,000, selling the home is the equivalent in this case of dying. So the company then says, hey, here's the $500,000 that we owe you per this contract. Well, your spouse or your beneficiary couldn't then say, it wouldn't make sense. It'd be economically illiterate to then say, thanks for the 500,000 for the sale of the home, but where's my 150,000 in equity on top of that? Or to say, hey, insurance company, thanks for the $500,000 check. My husband had $150,000 cash value. Where is that? That was your equity stake in the insurance policy. That is your home equity in the current value of the home, right? So just if the numbers help you visualize that. So talking about cash value, most people's experience with cash value who have had a negative experience with whole life comes from the same thing, but a different term for it is a cash surrender value. And so when Brian and I both surrendered our whole life policies, the amount that we got was our cash value. That was the cash surrender value. And so let's say my current policy that I have, my whole life policy, we'll say it's $1 million death benefit. The company is saying, hey, you're going to pay me premiums over the next however many years for a long time, and we're going to grow that money. You're ultimately paying pennies on the dollar for this future death benefit, but we haven't had the decades and decades to grow that money. If you want to let us off the hook for that $1 million that we will pay to your spouse at some point, you can let us off the hook for that, but we're not going to give you the whole million because we haven't had time to grow it and you haven't died, which is the contractual tripwire. At that point, when I die, my wife gets the $1 million, right? That's going to happen at some point in the future, guaranteed. And what we're trying to do with this product is match a guaranteed event, death, to a guaranteed payment. But if you want to let us off the hook for that $1 million, we will do that, but you're not going to get the whole million. You're going to get the million, what that million is worth today. That is your home equity, you could say, your equity stake in that future payout. And so that's what the cash value is, that current representation of a future payout. It's part of that future payout, but the future payout hasn't materialized yet because you are still living. And they're still assuming via actuarial math that they will have time to grow that money. So just trying to drive home that point of what the cash value is and why that analogy of, or that criticism of they keep the cash value and only give you the death benefit is incoherent, just because it's not two separate things. It's just one is the current representation of the future value of the other. But there is no cash value without a death benefit. There is no future death benefit. Like any future death benefit, it inherently has, if it's a permanent death benefit, means it's guaranteed, so not term. Any whole life death benefit has a snapshot value today, and that is the cash value.
I think that a big part of the reason that this myth exists out there is because the same people who make this stupid claim, and I don't call it stupid intellectually, I'm calling it a stupid claim because I believe they know the difference. The Dave Ramseys out there who say this stuff, I believe that they're being deceptive, because what the most folks who say this also teach is to buy term the difference. And so when they do that, or when somebody would do that, you would have two separate entities. You would have a death benefit that's going to expire that you're leasing. If you die when that contract is enforced, let's say you did a 20-year term, you would get the death benefit. And since if you were actually investing the difference, which we'll talk about that in a future episode, your spouse or beneficiary would get that. And so they're trying to say, here's what I tell you you should do, and here's why it's better, and here's what the whole life insurance people don't do. And they're taking two completely separate things and trying to pretend like it's the same. And I believe these people know better.
Yeah, and that leads us into the next myth, which is that all insurance performs the same task. So we're going to talk about two types. We'll do broad strokes here, but permanent versus term insurance. So permanent insurance is going to be whole life. It's going to be universal life. It's something that has a guaranteed future payout. Now, we don't do universal life in any of its flavors. So that is a whole other topic for another episode. We're going to say that is in the permanent category. However, there are a lot of stipulations with that, and especially the newer monstrosity versions of it. There's a lot of ways that those could be not permanent depending on how it's used. However, for the purposes of this very broad overview of permanent versus term, permanent insurance is a guaranteed future payout, whereas term is essentially renting insurance. It's the way that we commonly think about insurance for any other product. You're paying a premium. All that premium is doing is getting you death benefit in case something happens, in case you die. So by renting that insurance, your premium goes exclusively to death benefit. Now, the reason it's so much cheaper in one sense, if you're just comparing premium amount, is that about 99%, depending on which companies you talk to, anywhere from 1 to 2% of term policies ever pay out. And therefore 98 to 99% of term policies expire with the insured still alive. Nobody wants a claim on a term policy, because what does that mean? That means you died while the term was in force. Everyone wants to outlive their term policy. And so term is the least expensive if you die during that period, because the same price tag of premium for $1 million death benefit, term versus whole life, the term is going to be a much lower dollar amount. But when you outlive it, which 98 to 99% of people do, it became the most expensive form of insurance because it was 100% loss, because now it's no longer in force and all premium. You had no living benefits. You didn't get to use it. And the company keeps 100% of that premium. There is no guaranteed future payout. That's overview of term versus permanent. And so we'll let Brian cover some of the broad strokes of permanent before I make an analogy that hopefully ties the two together. So comparing the term to a permanent policy, the permanent policy has that guaranteed future payout. And so you can make a comparison here of renting versus owning a home. I'll say quote owning because there's a lot more to that. But when you rent a home, you pay your landlord money, but you don't gain any equity in the home. And once you leave, you don't have any equity stake in the home. Your landlord does. The owner of the home does, because you were renting that house or that apartment. You leave and everything you paid towards rent went towards, it wasn't wasted. It went towards something. It went towards, in this case, shelter, or in a term insurance policy, it went towards providing a safety net in case you did die during that term. But once you outlive that term, or once you move out of that apartment that you were renting, you don't have anything to show for that money that in the future that you paid in the past. Whereas with a permanent insurance, it's more like buying a home. So you are paying more for that right, but you are also gaining equity in the home. Or in this case, with insurance, you are acquiring cash value, you're unlocking, you're earning cash value by the passage of time and by the premiums paid, so that at any point you can point to what the actual value of what you have paid for, if that makes sense. So you're locking in a level premium for life. You're locking in a guarantee. And like we talked about, you're matching that guaranteed future event, AKA dying, with a guaranteed payout from the company. The day that you walk off this earth, the insurance company walks in to make sure that you are whole, your beneficiaries are whole for the lost income, the lost production, and then the loss of life that they're suffering.
And to tie all these together, like when we look at one of the claims about all insurance forms the same task and everything comes down to the level of premium, the amount, and everybody looks at what is the cost. And nobody ever talks about cost and value. It's just cost. But truthfully, they all cost really the same thing. If that's all we were looking at, then 1 year term be your most cost efficient, because the actuaries could say it's pretty unlikely that this person is going to die this year. Here's the cost. But the problem with that is every single year you'd be a little bit closer to death, and that price would go up and up until it doesn't make any sense to buy it anymore. You would price yourself out of it. So what they try to do with term insurance is they try to level cost over, let's say, 20 years based on how old you are, maybe 30 years. 30 years is the longest I know of that you can get a policy. And so you're paying more upfront to level out the cost later. And then it's going to go away. And all the things that Fonz just talked about as far as renting it goes. And whole life, they're still doing exactly the same thing, except they're not going to cut it off in 20 or 30 years. The most expensive point of your life is at the end. The cheapest place to insure you and to take that risk away from you is now while you're young. And they're going to try to level that out as best as they can. But it is, just like he said, matching that guaranteed event, your death, with a guaranteed outcome. And they're not offering the guarantees when it comes to 1 year term or just basic term. They're offering a probability of it happening or not happening. And if it happens in this X amount of time, then they give you the guarantee that they will pay it out. But it's not guaranteed no matter when it happens. And I think that's important because one of our mentors always says, Trent Fortner, we all live until we don't. And it sounds like such a funny little phrase, but it's absolutely true. There's going to come a time when all of us no longer live.
So tying this all together, as far as the pricing of insurance goes, let's say you're 30 and you knew with certainty that you were going to die at age 90. If you try to take out a 60-year term policy, it would be priced the same as a whole life policy, because if the company had that information, that perfect information that is unknown, but if they did know that they were going to guarantee that a payout to you because we knew when you were going to die, that term policy would look very similar in price to the whole life policy, because they're now assuming a guaranteed payout rather than a possible payout. And so yes, term is cheaper, but if you outlive it, it becomes just an expense. The same way once you sell a car, you don't keep insurance on that car anymore. So there is some truth in the fact that term is cheaper, but that's because of what you're purchasing. It's a very different product when it's a guaranteed payout versus a possible low likelihood payout. And then what happens when you outlive that term policy is if you want to have that coverage in place and you want to take pressure off your other assets, you're going to need to renew that term. And now you're 20 or 30 years older and possibly uninsurable, but certainly, if still insurable, much more expensive to insure. And you're going to hit a point where it becomes prohibitively expensive to get another term policy. And so that's where this idea, this Dave Ramsey idea, buy term and invest the difference, falls apart, because every time in this sequence of doing that you outlive a term policy, you make exponentially more expensive to get another term policy. And if those assets aren't performing as projected, this 12% annual rate of return fallacy, if those assets aren't performing as expected, you've now put all the pressure on those, because this death benefit that you could have locked in earlier doesn't get to carry the weight and take the pressure off of those assets who now have to perform the entire job without any reinforcements or safety net of insurance.
Yeah, another potential myth that we often hear is that life insurance is an afterthought and just it's only good for after you die. And one, if that's what you're worried about, is I think maybe unless you don't have any loved ones, unless you have absolutely no charities you want to leave money to, if you don't understand the living benefits and how this can benefit your life and enrich your life now, it's really a excited thought process. Don't we want to enrich our children? Don't we want to enrich our spouse? Don't we want to enrich somebody we love and care about? We should be thinking about our posterity. We should be thinking multiple generations down the road. It's one of the worst things that we as Americans do, is everything is so short-sighted. We can't think a month out, let alone a year out, let alone 100 years out. But yeah, even if that were the case, for pennies on the dollar, I can guarantee an outcome that is going to make my family more wealthy, that is going to protect my assets, that's going to protect all the things that I put money in, that's going to mitigate the tax disaster that's on its way. Because as soon as you walk out, the government has a plan for your entire estate. And so if you don't have one, they do. And it's really darn expensive. And I want to mitigate that for my family. And we touched in episode 1 about some of the living benefits, and we're going to really dive deep on those in the next episode. But if you structure these policies correctly, or any whole life insurance policy really, but especially the ones from mutual carrier and the way we structure it, you have access to those living benefits from the day you start the policy until the day you're gone. And some of those are things like that control, the liquidity, the use, the equity you're gaining in the policy that we just got done talking about, all the guarantees, the flexible loan provisions. So once again, as Nelson laid out for us, the major problem infinite banking solves is that we finance everything we buy. Who's doing the control and who's earning money on that process? And so if we do this, if we use this tool while we're alive, we take over that financing and we become the benefactors. And it's the only tool I know of where we can get that compounding interest that continues, whether we're leveraging our money, or whether we're spending it, saving it, or investing it. So it's absolutely phenomenal. So it's not an afterthought for when we die. That's just like the cherry on top. If I could do this without it, I probably still would. It just absolutely outperforms every other savings vehicle in existence and allows us to constantly compound our capital, whether we're using it or not. And that is an absolutely phenomenal thing that nobody seems to want to pay attention to when they focus on this myth. That I've even had some people tell me that this is crazy to me, I don't want my wife's future husband to be rich. And so you want your wife to be poor simply because you're gone, because she might remarry because she's young. That's absolutely insanity in my mind. Like, you care so little about your wife and your kids that because you want some dude who you don't even know exists when you're dead to not get money. If that's the way you're thinking, maybe this isn't for you, but the things you can use for it while you're alive matter anyway. That death benefit is just a beautiful extra thing that costs us pennies on the dollar.
And you brought up an interesting hypothetical that I hadn't really thought about. What if there wasn't a death benefit attached? Or let's be a little more practical and let's just say in this savings vehicle, rather than an outsized death benefit where you get many multiples of dollars that you put in get paid out to your beneficiary, what if the only return when you died was the dollars you put in? You got a 1-for-1. So you get all these living benefits while you're alive, but theoretically, in this hypothetical question, if your spouse only got the dollars that you put in when you passed, but you got all these living benefits in the meantime, would you still use this as your savings vehicle? The more you come to understand all of the power of these, there's a no-brainer. Would I rather keep this money sitting in my checking account or my savings account, my money market account, or would I rather have these rights? Because that's what you're getting with a money market account, a savings account. When I die, my wife just gets the dollars that are in there after the tax man gets his cut and goes through probate or whatever if I don't have a trust. But every other vehicle, when you die, the amount that's in there is what they get. With insurance, it's many multiples of that. But even if it wasn't, would you still do IBC if you got the same poor 1-for-1 return that your savings account would give? And 100% hands down, I would do this.
And you and I both pay very large premiums in relation to the income that we have. And I think about what you're asking. And one of the next myths is going to tie beautifully into this, because another big myth is that your cash value in a whole life policy grows so slowly that it takes forever to be able to use anything with it. And it's like, the way we design these, that's just simply not true, because we use provisions that are part of the contractual provisions and riders within the policy that allow us to have more cash value faster. And we're going to talk about that a whole lot more in the future when we talk about mechanics of whole life insurance. But we overfund these policies. So within the first 30 days, if we pay an annual premium, we have access to a large portion of what we paid. Now, here would be the risk in that hypothetical scenario. It's going to take a couple years that we're going to have what we like to call the cash drag. And that's the expense of the insurance, the underwriting, the commissions, the administrative costs to get the policy set up. Nelson in his book describes it as starting a business. Nobody starts a business and expects to have every dollar available on day one. And so risk would be in that hypothetical that, okay, I'm going to do this anyway. And if I died in the next, say, 4, 5, 6 years, maybe my wife would lose some money. I would have to plan to, I might not want to start that at 70 without a death benefit, but there is a death benefit. So it doesn't matter. It's hypothetical.
Right.
That's the problem, is people are like, you're losing access to cash. Your cash doesn't grow super fast. And thinking long range, or are we thinking short range? Because the way we build these, we actually have access to a good chunk of that money right away. And it's funny, while we just got done talking in depth about saving and investing, and we truthfully shouldn't compare those, I'm going to draw a little bit of a comparison for a moment. And not because you should do either or of these, you can do both, but everybody likes to compare this to a 401k. So let's say that their comparison was valid. When they put their money in the 401k, do you know anybody at all that gets wrapped around the axle about their returns in the next 2 to 3 years? I don't know a single person. And if they put money, let's say that they go to the Mac, or let's just say they put $10,000 in their 401k and it was 2007, 2008, 2009 happens, or any of those people, they might be upset they lost money, but any of those people like, I can't believe that this went down. I can't believe I don't have access to all 20 grand I put it in the last 2 years. Every one of them expected the potential for it to lose. So nobody tracks everybody puts money into those vehicles with the expectation to do it through their entire working or 20, 30 years, and then in the end have access to it. But one of those risks, or one of those myths here that people get all worried about, is if I pay this premium, I can't access all of it right away. What other vehicle are you worried about that in? Why does that absolutely matter? And guess what? We can access a really large portion of it right away. In just a few short years, the reason we both said 100% on that hypothetical is because we're going to have access to all of it quickly. It's an and asset, just like this little thing I have behind me here. We can save our money in this wonderful environment that has that death benefit and use it to do other things in our lives. And there's no other asset we can do that with. So I will give up a couple years of illiquidity due to the cost of the policy in order to have access to that for the rest of my life, and access to a large portion of it, and eventually access to all of it. And it doesn't take anywhere near as long as people think. I've heard 15, 17, 20 years until you have all your money. And that's just absolutely not true. If you work with people that know what they're doing, structure the policy well with a participant participating mutual life insurance company like we do at Remnant Finance?
I'm 2 years, 2 premiums paid, and I've got 2 rental properties in a real estate syndicate that I'm investing in out of my policy within the first 2 years. And the second rental property was added after I made my second premium. So with one premium payment, I had a rental property and a real estate syndicate that I was investing in. We're going to get into a lot more detail on what we're doing individually with our policies. It's so true, that idea that people look at other products and don't think about the short term, whereas we spend a majority of time when we're going over illustrations with clients and prospective clients and members of our practice, we spend a lot of time looking at years 1 through 5. And that's natural. I did that when I first started looking at this. It's very natural to look for that, but this is the only asset. And again, it goes back to how much time did you spend thinking about the decision to invest in your TSP or IRA? Almost zero time. And we spend hours and hours talking through this with people. And that's good. That's what they should be doing with all of them. But this is the one where people really deep dive in. And to summarize, to wrap everything up here, these myths that we talked about, we can pull up a share screen and show you in a legal contract how those myths are not true, and how we can back up everything we said here today with a legal contract. And we can walk you through that. And when you go through our onboarding process and do an introductory call with us, we can show you all of that. We can back up every claim we're making here today. And so these are actual myths that are put out there, going back to the beginning of this episode and how public opinion is formed. Where did you get that idea? And if we can counter it and show you in a legally binding contract that it's not true, is it worth your time to explore this idea and reconsider your priors?
And just to clear that up, he said show you in legally contract, not an illegally binding contract.
Yes.
Which is how it sounded, but perfect summation of your introduction about Brene. Yeah, everything comes back to that. Like, why are we diving into these tiny little things? Because we think that because we've been pitched via marketing that this is not a great product, and all of that is based on somebody else's misunderstanding. So hey, hope to see you in episode 3.
Cheers.
See ya.